Welcome to the Business Advocate. My name is Russell Carriere with First Choice Business Brokers, and today we are going to talk about lending. We have Jared Johnson, who is the Vice President and Senior Business Development Officer with First Internet Bank, the SBA division, where he provides nationwide lending. So we have a guy that's been doing this for quite some time, 17 years. So we can take his word as valid. Some of the areas that we're going to cover today is the state of the banking industry. There's a lot of talk about it. Rates, of course. Everybody's always concerned about rates. So we're going to have a quick discussion about that. Then we're going to talk at a very high level today on SBA loans, the different types, and then what the SBA has done over the past several months to try to initiate more loans. And so, Jared, welcome to the show.
Thank you. I appreciate you having me on.
Oh, it's my pleasure. Do you want to add anything to your background?
No, I mean, I think you covered a broad version of it. I'm sure we'll kind of get into a little bit more of it, but love doing SBA lending for business acquisitions. I've also bought two businesses, sold one, so bring a little bit of a different perspective. But I'm happy to be here, and hopefully we can dive into some stuff.
Awesome. Greatly appreciate it. So let's talk about the state of the banking industry. There seems to be a lot of fear out there that there's going to be more consolidations and that with the financial crunch that's been happening or being claimed, that banks are in trouble. What do you think, Jared?
Yeah, it's funny because I kind of feel like over the last 2 or 3 years, they keep telling us that we're in trouble and that there's a credit crunch and that there's a bunch of problems. And then I've gotten busier and busier and busier. So I think it's a little segregated because what we do with anything M&A, smaller M&A, seems to still be moving along, fine. Nothing has really kind of beat it down, no matter how hard everyone's tried. So it's a little different than just kind of the overall banking industry. I do think that if you look at it as a whole, I have seen a lot of things slow down, especially in mortgage. Overall, like business banking has slowed down a little bit. So I don't think they're completely wrong with that, but I also haven't seen any like major problems. I'm not seeing a bunch of emails flying around internally that are saying we're in trouble, all these deals are going bad, all these real estate projects are going sideways like we did in 2009, right? So I don't necessarily think that we're in trouble. I think we've seen a massive slowdown when it comes to other parts of banking and lending. And part of that was sort of by design, I believe, with the Fed raising rates. So we're kind of in this odd transition period where are we actually in trouble or are we slowing down? Where are we at? But I don't think that we're seeing any kind of major problems or trouble at the moment.
I would have to agree with that. From my side, there's been a tremendous amount of activity. There's been quite a few buyers that are contacting us wanting to spend money, wanting to get loans. From my perspective, I agree with you 100%. I'm not seeing it.
Yeah, it's almost like you want to keep it quiet though from my side, right? I'm like, I don't want everybody just all of a sudden going, "Oh, I'm going to go be an SBA lender and jump in." And to kind of your point about you're still busy. I am seeing though among some of the other SBA lenders that they are pulling back a little bit on what they want to do. Um, and I don't necessarily feel like it's something that is trending down. I think what we saw was there was a lot of lenders before COVID that didn't do business acquisition lending at all when it comes to the SBA side. And they kind of jumped in when, rates were low, activity was high. You had a lot of people that decided, hey, I'm done with corporate America now that there's COVID and I can move across the country. Well, I might as well go buy a business, right? And then you also had the SBA trying to churn up more business by giving a higher guarantee. And then the loans selling on the secondary market were really high. So we had a lot of lenders jump into, something that they normally wouldn't do, which is financing business acquisitions. Now that things have kind of settled down a little bit, the SBA is not providing any more incentives for a higher guarantee, and then the secondary market has slowed way down. They're kind of going back to what they used to. So I don't feel like we're seeing any kind of decline in the industry. We're just seeing people go back to what they did before, which frankly is totally fine with me. As you know, I'll stay busy because I was doing it long before they decided to get into the market, and it actually kind of helps clients out a little bit because you have lenders that aren't as experienced coming in and trying to do something that they don't normally do and they don't really understand how to do. And now that they're kind of getting out of the way, the traditional players in the game can kind of see forward, and it really helps the clients out. So
Well,
we'll see how it goes moving forward.
it's the old saying, stay in your lane.
Yeah.
And so everybody listening, work with banks that do business transactions on a regular basis. It'll save you a headache. It'll save you time. Okay.
Absolutely.
So seek out people like Jared who have been in the industry for 17 years. They didn't jump in for a year and jump out. That's just my 2 cents on it. So let's talk about, you actually brought it up earlier that the Fed raised rates. Everybody knows this because they wanted to slow the economy down. Successful. They did. They slowed it down. So where do you see rates today?
Yeah, I mean, I do feel like they are, obviously much higher than they were and what people got used to. Is funny. I actually had a client that I did a loan for probably in 2010, and he came back to me maybe a year ago, and he said, man, my rate was a fixed rate when you did it this night. I said, no, it wasn't. It just never adjusted the whole time you had the loan. And he's like, oh my gosh, I never even realized that. So it's kind of funny, so it's come back up. When I came into the industry, it was about where we're at right now. People weren't too concerned with it. Obviously, transactions and volume was a little bit less. Then it got really low for a very long time. And if you remember correctly, in probably around 2018, they started to move them up, and it was the way it was supposed to, right? They said, hey, let's try to stop inflation, let's slowly move the rates up. And then we had COVID, and they said, well, we got to put them back down. And then of course, with printing money and all the other things that we've done, the inflation has gone crazy, and so then now they've got to try to beat it back down again. So moving forward, from what I'm reading and what I'm hearing, rates should go back down again in 2024. Whether that happens or not, none of us will really know, right? But typically, if that's what everybody's kind of projecting and seeing, then it most likely will happen. So if it does, then I think it will be good, because I feel like there are some clients that maybe bought the business or real estate even a couple years ago, and they're starting to feel it a little bit as their payment has most likely doubled. So I feel like a lot of them are kind of at that tipping point where they're saying, hey, I'm okay, I'm continuing to move along here, my business is not going to fail, but if we dropped rates a little bit, that would give me some breathing room to continue on. And so I'm hoping that's what will happen.
Well, obviously, if the rates do come down and it adds to a little bit of cash flow for a business owner, it allows that business owner to do more things,
Correct.
hire, expand, or possibly even buy another business. I mean, there's just a lot of things that would help our economy as a whole.
Correct. Yeah. Yeah. That, and then people that are on the fence right now or on the sidelines, thinking about buying a business, will likely jump in. So we'll most likely see even more of an uptick as more and more people retire and sell their business. You have more buyers. You have some buyers that have been a little hesitant over the last year and a half because of rates. So if they come back down, I think we're going to see even more buyers say, "Okay, it's time. It's time to do this."
I 100% agree with that as well. That's one thing that we've noticed is buyers are a little bit more hesitant. They are afraid of a rate that's out there today. As you mentioned, I mean, this is actually normal. These are the normalized rates that actually people have forgot about. And I think eventually people will get used to it and it'll be business as normal.
Definitely. Yeah.
Yeah,
Yeah, and obviously having an election year coming up will kind of play into that a little bit, I'm sure. So we'll see how that affects things.
absolutely. So let's move on a little bit. The SBA world is complicated. I mean, we could spend hours discussing the NBA. NBA. No, we're not going to talk about basketball. The SBA. So we're going to go at the very top layer. What are the different SBA loans available to people who want to buy a business today?
Okay, so realistically, as far as buying a business, there's really only one product. There's the SBA 7A program, which you can use for essentially anything that you need for a business. So you can use it to buy real estate. You can use it for equipment. You can use it for working capital expansion. But one thing that it does fall into is you can buy a business with it. Within the 7A program, there's also another program called Community Advantage, which actually just became permanent. It kind of been a pilot program for a long time. And about a month ago, they made it permanent. So with that, they do loans 500,000 and under, and it's a little bit of a different program. They use a scoring model rather than a full underwriting like a traditional 7A. So some people will use that to buy a business as well if it's a little bit less of a loan amount or purchase price. And with that, with the scoring model, it's a little easier to get. Downside is rates are a little bit higher. So those are kind of the two main programs that you'll see through the SBA.
Okay. I honestly, that's new to me, the scoring model.
Mm-hmm.
Can you talk a little bit more how that is different?
Sure. So the SBA has a lot of data, right, over the years that they've accumulated from their loan portfolios. And so what they've done is kind of tried to pull back some of that data and see what loans performed well and which ones had problems and why. And so what they've done then is create basically a system where you put in the information that they're requesting. Main thing is personal credit, industry type, loan amount, the client's liquidity, and then it will basically spit out a score. And that score is supposed to determine how likely they are to be paid back. So the minimum requirement is 140. And if you're over that, then you're supposed to say, hey, we're okay to move forward here. Now, every lender is probably going to have a little bit of a different, threshold of what they're good with on the score. But most of the time, the higher the score, the higher likelihood of getting the loan approved.
Okay. So you brought up another point that I want to kind of talk about is most people have the idea that when you get an SBA loan, it's 100% the SBA, they're approving it or declining it, but that's not necessarily true because the bank itself, the lender has their own criteria as well of the types of loans, the types of businesses that they'll actually loan against.
Yeah, that's probably one of the hardest things to get people to understand in our industry. A lot of people think about it like mortgage, right, with FHA lending, and with that, traditionally every lender that does FHA kind of does it exactly the same way because they're following the rules and regulations that are set. So with SBA, you do have the SBA guidelines, the standard operating procedures that the SBA puts out. We are required to follow. Anybody doing an SBA loan needs to follow those rules. It's about 400 pages now. They just put out a version of it on November 15th. They've even since then changed a couple things. So it's constantly evolving, constantly changing. Now, with that, of course, we need to follow those rules in order to actually obtain the guarantee that they make on the loan. So if somebody was to default or have trouble not pay back the lender who actually makes the loan, then the SBA would step in and they would provide their guarantee, which is usually about 75% of the loan, if you followed all of their rules. Now, on top of that, every lender has their own rules and their own kind of appetite for what they're comfortable with. And I think that right there is the hardest part to get people to understand, because everybody thinks, oh, I read the SBA rules. That means that every single bank does it, this way. They're just following the SBA rules. And then that's what they don't understand. So especially when it comes to very special, niche lending like business acquisitions, I would venture to say there's probably 3 or 4 lenders that do about 75% of the acquisition financing, which is kind of mind blowing considering there's about 1,600 active SBA lenders. So you could spend years applying at every bank in town, all across the internet, all over the place, and get decline after decline after decline. And unless somebody says to you, hey, this is actually a good loan, it meets the SBA guidelines, it just doesn't fit within our bank, then you're just going to keep spinning your wheels looking for something. Or a lot of people get discouraged and they say, oh, the SBA doesn't really want to make loans, and SBA lenders only want to do real estate loans, and they just get discouraged and they stop looking. And then really what they need to do is find out that each lender has their own box of what they're comfortable with, and you got to find where you fit in that box. Now, of course, there are some people that it just doesn't fit with anybody. But for the most part, you just got to find, what works for you with your actual specific credit request.
Okay. You said people actually read that 400-page document that's looking to get
I
a
mean,
loan. I don't believe you.
oh no, it's wild. I get kind of the armchair SBA experts. It's very, very interesting. I'll get an email or a call and say, you're doing this wrong, and I read the rules and this is what you're supposed to be doing. And I kind of laugh and I'm like, okay, well, how many SBA loans have you done? And
Yeah.
then you try in a nice way to kind of explain to them that how they're interpreting it or how they're reading it is most likely wrong. Or a lot of times, unfortunately, they're reading something that's really old and the rules are constantly changing. We had huge changes this year within the SBA program. And so a lot of people are still kind of stuck reading the old rules and regulations, or something they found on a blog post online, or somebody on Twitter told them, how to do it. And so it's a challenge for sure working with people like that.
Well, if it's on Twitter, it has to be true. So,
Absolutely. Yeah, everything on the internet is true. So.
so going back to the loan and the scoring, I heard of a loan. It's a quick start loan that the SBA does, where it's a quick closing.
Yeah, you're probably referring to the SBA Express loan.
Yeah.
So yeah, with that, it's a little bit different. So essentially what the SBA was trying to do is find a way to get the loans done quicker. Those are typically utilized for like the smaller loans that you do within a branch. So if you go into a local, typically even a large bank, and you just want a $50,000 line of credit, or maybe some working capital or a piece of equipment, they will utilize the SBA Express program to get that done. So most of the time, it's just a 1 or 2 page document that you're filling out. They'll run it through their system. If they approve it, it's usually just a couple pages for loan documents, and you're on your way. We utilize the SBA Express line of credit program. That's it. So on a lot of our transactions, if we're including working capital and we include a line of credit, it'll be an express line of credit. Otherwise, we don't make just express loans on their own. So when you're doing a acquisition financing, you typically want to do just a normal 7A loan because you get a 75% guarantee from the government. And with an express loan, you're only getting a 50% guarantee. So most lenders are going to utilize the traditional 7A program for obvious reasons.
for obvious reasons. So, in getting a loan with the SBA, and I kind of touched on it earlier, talking about how the SBA has their criteria and the lenders have theirs. There are certain businesses that the SBA won't touch. Is that correct?
Yeah, that's correct. So the biggest one is they can't have anything to do with cannabis. So if even if they support the industry, so a good example that I often will use is I had a loan request for a security company in I believe it was in Washington, and a very small part of their business was providing security guards at the cannabis stores, and we couldn't do anything for them because a piece of their revenue came from that, even though they're not manufacturing,
Right.
selling, doing anything to do with cannabis, but they are receiving revenue from that industry. So if it looks like that's what they're doing and you can kind of easily see that there's, some kind of connection there, then we can't make a loan to them. The other major ones is anything that's sexual in nature. They actually clarified that a little bit more. Historically, that's all it said, and then recently they clarified it even more to include gentlemen's clubs, stores, and kind of added a little bit more language to clarify it. And then from there, anything that is engaged in lending, so they can't be a direct lender, so essentially a bank, or if they're loaning their own funds out, like hard money lending, you can't do that. And then some of the other ones is just a certain percentage of the revenue can't come from gambling. So typically, we really only have to deal with that in some places like in Nevada where they've got the tabletop gaming, or if there's anything like that, we have to look and make sure what percentage of their total revenue is coming from gaming.
Okay.
So, and then another one that often kind of falls within the lending side are pawn shops, because a good majority of their income is coming from loaning money. So we usually can't do anything for pawn shops either. But those are kind of the main no, you can't do these. There's always every kind of business will have to look at and make sure is actually eligible. But those are the ones that are essentially on the you can't do anything for list. And then, of course, it has to be within the United States.
Okay. What about firearms?
Yeah, you can do lending for firearms manufacturers, retailers, gun ranges. All of that is eligible. But again, going back to what we were talking about before, you got to find a lender who's comfortable with it. So you will find that even as it shrinks down further, right, finding a lender that'll do business acquisitions and then finding one that actually does firearm retailers is even more of a challenge. So you kind of have to check with those major lenders that are comfortable doing that type of lending and see if they'll do it.
Very good. Yeah. To your point, so we're working with a business now that manufactures firearm parts. They don't actually make the gun itself. And I struggle trying to find a lender that would process a loan on it.
Yeah.
They're like, no, nothing firearms, no ammo. We don't want ammo stores. Breweries, all of a sudden. There's several lenders now that I'm talking to won't touch it. They won't touch restaurants. So,
Yeah.
to your point,
Yeah.
if you're not getting the answer from your lender that you're working with, ask them why. Is it a bank requirement or is it an SBA requirement? And if it's not an SBA requirement, go to another bank. Ask them specifically, will you lend on this type of business? Don't waste anybody's time and find that lender that works best for you.
Yeah, that's great advice. And for the most part, most of us know each other. So if it's something I can't do, and it's like you brought up firearms, my bank, they don't like to do actual direct firearm retailers or manufacturers. Now, if it's a part for a firearm, we'd maybe take a look at it. Then you could say, hey, such and such bank doesn't want to do breweries or restaurants, but most of the time, if you ask somebody there, well, who does, they probably know, right? We all kind of know each other. So it might be, it might be a case where you have to kind of get passed around until you get to that right person. But typically we know each other and it's a small industry. So you'll find the right one. But yeah, with breweries, I think, most of the banks just feel like they've kind of overloaded their portfolio with them. And there's so many over the last 10 years that have popped up that they feel like now it's kind of time to just work with the ones that are in existence and see how that goes, and they don't need to add any more.
So you keep bringing up all these points where if a lender has a lot of breweries in their portfolio, they want a diversified portfolio like an individual, right? They don't want all breweries and restaurants. They want warehousing. They want the retail. They want all these different types of businesses because they don't want all their eggs in one basket.
Correct.
So
Yeah.
again, just because that one lender may have a lot of breweries under their umbrella, the next lender down the street might not. So again, ask the right questions before you jump into the whole process of getting a loan and find out if they'll even lend in that category. Because it might not be just a regulation, it may be just they have too many.
Exactly.
So we're going to jump into our fourth part here. I know the SBA made a lot of changes this year. And obviously, you're going to talk about it more in depth. One of the ones that I learned about was one, the down payment requirement changed a little bit. And actually, I will stop there and let you talk about it.
Okay. Yeah, so they essentially clarified what the requirements are for down payment. So I'll take you back even further. So back when I started doing business acquisition lending and really got into it was probably about 13 years ago, and there was not a hard and fast rule. What the rule said was if there was $500,000 or more of goodwill, so essentially just the enterprise value of the business, not the equipment, then you had to put 25% down. Other than that, there was no rule. So the good, the good lenders that were even doing it were usually following along at 25% on every single deal. So whether you're buying something for, $1 million or $100,000, they still wanted 25% down. And normally what we would do would be 10% for the buyer and then a 15% seller carry note, and that met the requirements. Then a couple years ago, they finally came out and said everything across the board is 10%. No matter what, you have to put 10% down. So they got rid of the 25% and then kind of clarified on the other transactions that it's 10% across the board. So we were kind of happy about that because it gave us some actual guidelines to follow, and it kind of made it a little bit easier for people to understand. And then also being at 10% made it easier for clients. Now, again, we had to then get the banks on board with it because you have somebody that's been working in SBA lending for 35 years that already is struggling just to do a business acquisition because of the position that there's not much collateral, and it's risky. Doing business acquisitions is risky. You have a change of ownership. So trying to get them to go from 25% to 10% was already a pretty big challenge. Then we got them there, which was great for buyers and sellers. Then now they've actually clarified it even further. They've changed it now that half of the down payment requirement, so essentially 5% of the total project, can come from seller financing. Now there's rules with that. The first one was that it had to be on standby, which means that there's no payments due on the loan for at least 2 years. Now there was another part before that. It was 10 years. So they pushed that up to 2 years. And I really think they did that because it not only does it open up the buyer pool and it gets sellers to be a little bit more comfortable with it, but in reality, I can't tell you how many calls I would get where they would say, okay, so this has to be on standby and no payments for 10 years. what happens if we make those payments? And that was the calls I would get. And I would tell them every single time, you need to follow the SBA guidelines. If the seller is going to sign something saying they're not going to accept any payments, so if you do, you're in trouble. But realistically, what they were saying is, I'm going to just start paying this back and I don't care. So I think the SBA kind of understood that, and they changed it to 2 years, which made sellers more comfortable. Buyers actually like it. Gives them 2 years to kind of build up the business, build up their cash flow, build up their reserves before they have to start making that payment. So we felt comfortable with that as well. So they changed that. Then they added now that it has to be on standby for 2 years and it cannot have a balloon payment. So as long as it's fully amortized and then is paid all the way through, and it's on standby for at least 2 years, then it can count towards half of their required down payment. Then there's also, they added another piece to it, which a lot of people for some reason aren't using, but the language essentially says that you can do 3/4 of the required down payment on a seller carry note if the seller note is on interest only for at least 2 years. Now, the other part they added to that is it also cannot have a balloon payment. And then you have to be able to run the numbers, and then they work with the interest only period. So as long as you meet those requirements, then you can put less of 10% down out of pocket for an actual buyer. But either way, at 10%, it definitely opens up the market as well. So those were the new kind of down payment requirements that came out.
Okay. So flexibility. It
Yes.
allows a deal to be a little bit more flexible to get it done, especially for
Right.
buyers that don't have the 10% in cash.
Yeah, and I think that's what they were trying to do is kind of open it up a little bit, make it a little bit easier. A lot of times, what we're finding is that it's not so much the buyers that don't have enough for the down payment. They'll usually have 15-20% of the total project, but they want to hang on to their cash, and we want them to hang on to their cash. So it usually works out that way. Now there are definitely cases where they really only have enough for the 5% or maybe a little bit over that. And in those cases, it's typically that they've worked in the industry for a long time, or they've even worked for the specific business they're buying for a long time and became a good part of the business, the general manager or something. And with that, we're happy to help them get into that business with only 5% down.
That's awesome. That's great information. Uh, there's a lot of ways that a transaction can get done, and a lot of people guess. And this is where, excuse me, you want to talk to a professional. Okay, you call a guy like Jared, who understands what the SBA is allowed to do, the flexibility that you can build into a deal to buy the business that you want. Okay, so don't think you know everything out there. Everybody listening, talk to the experts. I mean, that's why we're doing the show. It is an educational show, okay, to help you and guide you, but we're not going to make you experts overnight, okay? We are introducing you to people that are the experts. Feel free to give them a call, ask them the questions. Now, I get a lot of buyers requests saying, I want to buy $1 million business. I don't want to put any money down. I hear that we can do a zero down payment plan and it can be amortized over 25 years and I don't have to make payments for two. Have you heard of any of these type of programs?
No, I mean, if you find out where they're at, like let me know. But one thing they did change recently is the seller can remain on and hold equity within the business. So historically, you had to buy 100% of the business. So typically, a stock purchase or an asset purchase, which we could spend 4 hours talking about, but now they opened it up that you do not have to buy 100% of the business. So that could be what they're talking about. So there are some rules which would also be pretty detailed. But if the seller retains 10% or more, then they don't technically have to put money in as long as they meet a couple other qualifications that would take too long to go over. But so they do have that ability. However, they have to keep in mind if the seller has 20% or more ownership at the close, they would also need to be on the loan as a guarantor. So the main way that the SBA wanted to entice people to do that was typically when they have a licensing requirement. So if the seller has a license that the buyer needs to operate the business, they can stay on at 10, 15%, and you can utilize that license moving forward, and that would also count towards their down payment.
That's interesting you say that, because in our state of Tennessee, the rumor mill is for, and you could be talking about a different license than what I'm going to bring up. Licensed plumbers, licensed electricians, contractors' licenses. Typically, when somebody buys one of those businesses, the owner would allow the buyer to utilize their license for a period of a year or two to operate that business. I'm hearing Tennessee is going to eliminate that altogether because we're running into all kinds of issues with that. And it's funny because now the SBA is accounting for it, but states might be pulling away from that model. Have you seen or heard of anything like that?
Yeah, I mean, each state is a little bit different. Like in Texas, the majority of those trades, you don't even have to have a license, which is a little scary, but it makes my life easier. But so with like kind of what you're referring to, so the SBA also has a guideline that says the seller cannot remain on as an officer or a key employee. Now, if they're holding the license, then they're both. So they would not be able to do that. It does have a provision in there that says it can be for a short period of time. Basically we're looking at, less than 60 days. If that's just the time that the buyer needs to take a test and transfer the license, then we're okay with that. But they have to be able to prove to us that they have the capability to do it and they're already working on it. If they still have ownership in the business and hold the license, then they would be totally fine because they still technically own the business. So with Tennessee, I'm guessing that's what we'll see happen, is that people will retain ownership in the business because then they technically haven't sold the entire business. They're still an owner in the business. They still have equity in the business, so they can still hold the license. It didn't need to be transferred. So we're probably going to see more people do that way as well, which personally I I'm a little mixed with. I like to see that the seller stays on. A good majority of the deals we do when a buyer is buying a business like construction, contractor, plumbing, they don't oftentimes have a lot of experience in that trade or have a license, but they've got everything else that most likely that seller doesn't have when it comes to a skill set. So a lot of times when you put them together, it works really well. But then on the flip side, the only deals I've had that have really struggled over the years, which isn't many, is usually a partnership. So, it's tough. I always kind of say you're going to speed date this person for 2 months, and then you're going to marry them, and then hope everything works out and you pay us back, right? So it can become a challenge to get it all to work together. But a lot of times we're seeing it does work.
Awesome. So, Jared, I'd like to say thank you very much for your time today. Um, there's obviously a lot more that we can discuss and get deeper into this topic. And I hope that you would like to join us again in the future. It was great having you.
Yeah, it was fun. Absolutely. Anytime.
So, Jared, go ahead and let everybody know who you are, who you work for, and how to reach you.
All right. Yeah, my name's Jared Johnson. I'm a senior business development officer and vice president of First Internet Bank in the SBA division. I specialize in financing business acquisitions. As far as I've seen, I do more transactions than anybody in the country, so I'm happy to help you with my experience and knowledge. You can send me an email. It's J Johnson, so the letter J, last name Johnson, at first spelled out FIRSTIB, like internetbank.com. So jjohnson at firstib.com.
Awesome. You're going to get 2,000 emails. You know that, right?
I mean, that's a pretty normal day for me. So thank
Thank
you.
you very much. So everybody, please hit the subscribe button, hit that like button, ring the bell, all the things that you're supposed to do on one of these things. My name is Russell Carriere. This is the Business Advocate. Thank you very much for joining us, and we'll talk to you soon. Have a great day.